When most people see the images from Venezuela, they see something familiar: helicopters overhead, soldiers on the ground, and a sudden change in power. News coverage focused on the spectacle, on strategy, politics, and the immediate fallout. But to understand why this happened, we need to step away from the footage and look instead at data, specifically energy data and financial systems, because what happened in Venezuela wasn't driven primarily by ideology or democracy. It was driven by oil and by the system that controls how oil is bought and sold. At the center of this story is a little-known asset, the United States Strategic Petroleum Reserve. This is America's emergency oil supply, created in the 1970s after the oil shocks and intended for moments of severe national crisis. Over the past few years, the reserve has been drawn down aggressively. Millions of barrels were released to stabilize fuel prices and reduce inflation. Politically, it worked. Economically, it created a vulnerability. The reserve is now at its lowest level since the early 1980s. At the same time, the global system that underpins US economic power, the petrodollar, is weakening. Since the 1970s, most oil transactions worldwide have been conducted in US dollars. This forces countries to hold dollars in order to buy energy, creating constant global demand for US currency and treasury bonds. This arrangement has allowed the United States to run large deficits, print money at scale, and absorb inflation in ways other countries cannot. It's often referred to as America's exorbitant privilege, but that privilege depends on cooperation. In recent years, that cooperation has eroded. Russia has demanded payment in rubles. Gulf states have experimented with non-dollar settlements. BRICS countries have expanded trade in local currencies. Even Saudi Arabia, the cornerstone of the original petrodollar deal, has signaled a willingness to move away from exclusive dollar pricing. Venezuela holds the largest proven oil reserves in the world. Not the easiest oil to extract, but among the most abundant, and critically, it's heavy crude. This matters because US refineries were designed decades ago to process heavy crude, not the lighter oil produced by most American shale fields. While the US produces a lot of oil, it produces the wrong kind for much of its infrastructure. Historically, this gap was filled by imports from Saudi Arabia and Venezuela. But Saudi Arabia is now coordinating production cuts and pivoting east. Venezuela, under sanctions, has increasingly redirected oil toward China. And according to multiple financial and intelligence reports, Venezuela was preparing a much larger shift, pricing its oil outside the dollar system, potentially through BRICS-linked payment structures and non-dollar currency baskets. If that had happened, it would have sent a powerful signal to other resource-rich countries that it's possible to operate at scale outside the US-led financial system. From Washington's perspective, this posed two risks at once. First, a physical risk, a shortage of heavy crude at a time when global supply is already fragile. Second, a systemic risk, reduced demand for dollars and US debt, which could push interest rates higher and destabilize an economy built on borrowing. Faced with those constraints, US policy shifted. Years of sanctions, diplomatic pressure, and indirect influence had failed to produce compliance. As oil prices rose and reserves fell, time ran out. This reframes the intervention not as regime change for political ideals, but as a form of economic enforcement, securing supply and preserving a financial system. In the short term, installing a cooperative government may stabilize oil flows and allow Venezuela's production to re-enter dollar-based markets. US companies are likely to return. Contracts will be rewritten. Oil will move again. But the long-term consequences are more complex. For countries across the global south, the lesson is clear. Monetary independence carries geopolitical risk. But that lesson doesn't inspire loyalty. It encourages diversification. States respond by increasing gold reserves, trading in local currencies, and building parallel financial systems that reduce exposure to US pressure. Historically, dominant powers shape systems that others want to join. Declining powers rely more heavily on enforcement. This moment signals a shift from persuasion to coercion in maintaining the dollar system, and coercion scales poorly. It works in isolated cases, but not against large coalitions. BRICS is no longer marginal, nor is the move toward de-dollarization. Ironically, actions meant to defend the dollar may accelerate the search for alternatives. The images from Caracas will fade from the news cycle. Markets may even react positively in the short term. But beneath that surface, something more permanent has changed. The rules-based international order is only credible if rules apply consistently. When they don't, legitimacy erodes. What this episode reveals is not strength, but dependence on cheap energy, on enforced currency norms, and on systems that are increasingly contested. The oil may continue to flow, but confidence in the system that governs it is moving elsewhere. And once trust leaves a financial order, it rarely comes back.